In today's video, we're going to discuss how can I get more cash than the money that I put into the policy the absolute fastest. And so today's video, we are about to have a ton of fun. Let's get after it. So what we're going to do is we're going to talk about multiple factors: age, gender, design, company, all these different factors that influence the amount of cash value you have versus the amount of premiums that you put in. When we talk about this, it's called the break-even point. So break-even essentially means I have more cash value than I put into my policy. That is super important for business owners, super important for real estate investors, for investors in general, for people who want high liquidity early on so they don't miss out on the lost opportunity cost of their dollars to be able to borrow against their policy to use for that asset-based activity. So let's go ahead and take a look at the numbers. I'm going to go ahead and share my screen with you right now, and let's have some fun with it. So first and foremost, I'm going to go ahead and share my screen so you can see exactly what I'm looking at. You can see here, I'm putting myself in this top corner so you can see me as well. All right, so let's have some fun. We talked about a few different factors we're going to take a look at, and we're going to talk about how can we get the most bang for our buck to have as much cash value early on so we have the ability to break even sooner, which that break even point, once again, is having more cash value than the money that I actually pushed into the policy. So if we're going to go ahead and take a look at this policy here, we're going to have a net cash value column here. So net cash value. And then you're going to see here, we're going to come over and you're going to say cumulative premium. All right. So a well-designed whole life policy using a mutual company that pays dividends. If you can see a policy break even anywhere from year 6 to 7, that's typically going to be a well-designed policy. There's going to be a few other factors though that can influence that we can get it a little bit sooner or a little bit later. And I'm going to break down each one of these factors in separate videos at a deeper level, but I'm going to give conceptually a 60-foot overview of each one of these concepts and why they help and why they affect the performance the way that they do. So we'll go ahead and take a look at this policy as a whole and see what does the design look like. Year one, $100,000 is what's been into the premium. Okay, so here's the contract premium as you're taking a look at it. Here, you're going to be able to see the cumulative premium, the amount of money that we've total put into it. And here is our net cash value. So we put in $100,000. Year one, you have the 92.3% cash value available after year one to be able to use to borrow against for whatever purpose you want. That is an extremely high amount of liquidity for any type of insurance product to be able to use after year one. So here's why this is happening. A couple factors. Age, super important, okay? The younger the person is, the better performance is going to be. And there's a caveat to that. Kids do not perform the same way. It is somebody who is over the age of 18 that is going to be a dependent, that has the ability to have one of these policies owned by themselves. So when we're looking at this is a 35-year-old individual. And on top of that, the next factor is going to be gender. Gender is female. Females in general have a higher expectancy to live longer than a male. Therefore, their efficiency on their policy is going to be slightly better. The other factor is going to be health rating. Here is a super preferred non-tobacco user. When we're looking at health ratings play a critical piece into it. Whole life is going to be great, even if you have a standard rating, a preferred rating, super preferred, but the better rating you get, the more efficient your policy is going to be from cash value and also going to be from a death benefit perspective. So of any of these factors, if you're a male, it'll be slightly less efficient. If you're a younger age, slightly over 35, anything older 35, it'll be slightly less efficient. And if you have a health rating that's less than super preferred, standard, so on and so forth, it will also be slightly less efficient, which means that you'll break even. And I'm going to reiterate that again. Break even means having less cash value than what you put into it. Break even is essentially having more cash value than what you put into the policy. Will be affected by all three of these factors. All right. The next factor is going to be company. Some companies, doesn't matter how you design it, how efficient you design them, what the split is, it does not matter. Getting a policy to break even sooner just is not possible based off of the company's parameters. Some companies, they perform better long-term. Some companies' dividends are better. Some companies have stronger performance. Some companies are strictly specific for higher early cash value products, higher higher early cash value specifically. Some companies are just designed differently. They are all their own separate business, therefore they're going to perform different. This company here is essentially, in my opinion, the number one company that I would use for a highest early cash value is the goal. All other factors discounted. Nothing else really mattered. This is all I wanted. Then this company here specifically is a company that I would say was going to give you the highest earliest cash value, which is why I'm sharing this with you. And from complete transparency, we use like 4 different companies that we work with. And it's going to depend on the design that you want, your goals, what it is that you want out of the contract. And so that's why when you have a conversation with us, we're trying to ask those questions to try to figure out what company makes the most sense for what you're trying to accomplish at the end of the day. The other thing is the design. The design is super, super important to get higher early cash value. So when we're talking about design, we're looking specifically at a base to PE ratio, the riders that we put on the policy, and essentially trying to create as much liquidity as possible. So for instance, we want to do our best we possibly can to lower our expenses. Lower our expenses means making the base. And I've created a video on what base is. If you want to go ahead and check that out, you can search that. And then also trying to increase the PUA to as much as we possibly can to make the policies efficient and high early cash value as possible, because PUA goes directly to cash, base is directly to benefit, death benefit is mainly an expense. And it's an expense because it's a cost for that piece of insurance that we're paying for. Now that base is essentially going to convert into dollars later on, typically starting in year 3, but high PUA is what we're looking for, because high percentage of that means high earlier cash value. So this policy specifically has 85% PUA, 15% base, okay? There's a term rider that goes into that PUA section, so it's probably a little bit lower, but from a perspective, typically splitting it up to base and PUA, 15% base, 85% PUA. I can't go any higher with this design specifically, and it's typically because I'm putting in so much money in the first year. If I were just to do a $50,000 all the way down, I could probably decrease that base just a little bit more. But because I'm putting in $100,000 year 1, the most the insurance company will allow me with this specific design and product is doing an 85% PUA to 15% base. So you'll see here, it produces almost 93% liquidity after year 1. And from a break-even standpoint, we'll see here $250,000 has been put into the contract, $250,782. So we officially have more cash value, net cash value column here, than the amount of money that we put in, cumulative premium here, so $250,000. This happens at year 4. Year 4 is essentially unheard of in the industry for this happening, but if all factors are right, age, gender, health rating, design, company, if it all falls into place perfectly, we can get a policy to break even at this point. Now, complete transparency, this can't happen for everybody because not all those factors are going to line up properly. But I'm going to go ahead and look at the next, what we're going to go ahead and do is we're going to take a look at deeper dive into each one of these. We're going to compare policies. If we change the gender, if we change the age a little bit to somebody older, if we change the health ratings, we'll see how those affect the policy specifically. I'm going to make those in separate videos next. So I hope you got a ton of value from this, but these are some of the main factors that equate to why we can get a higher early cash value policy. And specifically, it's around those 4 factors. And those 4 factors are going to be different for everybody. Like I said, if we can get it to break even, between year 6 and 7, it's going to be a well-designed, it was designed by the person who's serving you, they did right by you. So if you have any questions, let us know in the comments. We're looking forward to hearing from it. Talk to you soon. Bye.
Hey, I want to thank you so much for watching this video to the end. This video is on life insurance, and if you have more questions about life insurance, infinite banking, why you should overfund it, we have a link below that goes to our And Asset Vault. This is a free vault that gives you everything you need to know about life insurance. We have case studies, we have a calculator on there, we have a handbook, we have frequently asked questions, we go through a process. I have my masterclass on there. We literally want to be the one-stop shop for every life insurance decision. And so if you want to learn more, click the link below, and we look forward to educating and maybe opening your mind and eyes to the power of life insurance.